What if the world's most powerful asset manager wasn't fighting Bitcoin, but positioning to control it? For years, crypto was seen as a rebellion against Wall Street. A financial revolution. A system outside the control of banks and governments. But now, the biggest name in traditional finance, BlackRock, has entered the arena. And when a $10+ trillion asset manager moves into Bitcoin, it's not random. So the real question is this adoption? Or is this control? Today, we're breaking down what BlackRock is actually planning with Bitcoin, and what it could mean for your financial future. Before we talk about Bitcoin, you need to understand the scale. BlackRock isn't just a big investment firm. It's the largest asset manager in the world. Founded by Larry Fink, BlackRock manages trillions of dollars for governments, pension funds, institutions, and global corporations. They own major stakes in Apple, Microsoft, banks, energy companies, defense companies. They are deeply connected to central banks and policymakers. When BlackRock moves, markets react. So when they decided to enter Bitcoin, it wasn't speculation. It was strategy. The real turning point came when BlackRock filed for a spot Bitcoin ETF. After years of regulators rejecting similar applications, BlackRock stepped in, and suddenly the approval odds changed. Why? Because BlackRock has influence, structure, compliance power. Their Bitcoin ETF allows traditional investors to gain exposure to Bitcoin through regular brokerage accounts, without holding private keys or using crypto exchanges. This changes everything. Instead of crypto-native platforms dominating Bitcoin demand, Wall Street now has a gateway. And here's the strategic layer. ETFs bring institutional money, retirement funds, pension capital, conservative investors. Bitcoin moves from rebellion asset to portfolio allocation asset. That's a massive narrative shift. Now here's where it gets interesting. When institutions buy Bitcoin through ETFs, they don't hold it themselves. Custodians do. Large financial institutions begin controlling large pools of Bitcoin on behalf of clients. And while investors own shares, the actual Bitcoin is held by centralized custodians. This creates a new power dynamic. Bitcoin was created as a decentralized system, no middlemen. But ETF structures reintroduce intermediaries. It doesn't kill Bitcoin, but it reshapes how most people interact with it. And BlackRock understands infrastructure. They're not just buying Bitcoin. They're building the rails around it. Why now? Look at the global environment. Rising inflation. Massive government debt. Dollar concerns. Geopolitical instability. Institutional investors are searching for alternative stores of value. Gold has traditionally filled that role. But Bitcoin is increasingly called digital gold. BlackRock has long supported traditional safe haven assets. So adding Bitcoin exposure isn't abandoning the system. It's hedging the system. And there's another angle. If Bitcoin becomes a permanent asset class, the largest asset manager in the world wants to dominate that sector early. Just like they did with ETFs in traditional markets. It's not emotional. It's positioning. Here's the core debate. Is BlackRock validating Bitcoin? Or absorbing it into the traditional financial system? On one hand, institutional demand increases price stability. Regulation brings legitimacy. Pension funds entering means long-term capital. On the other hand, centralized custody grows. Wall Street influence increases. Narrative control shifts. Bitcoin was designed as a peer-to-peer system. But financialization changes incentives. The more Bitcoin integrates into traditional finance, the more it behaves like traditional finance. That doesn't mean Bitcoin fails. It means it evolves. Think long term. If Bitcoin becomes a treasury reserve asset, a hedge for institutions, a permanent ETF allocation, a collateral layer in financial markets, then whoever controls the largest on-ramps controls influence. BlackRock doesn't need to control Bitcoin in a direct sense. They just need to control access, capital flows, institutional exposure. And from a business perspective, that's brilliant. Because whether Bitcoin replaces parts of the system or becomes part of the system, BlackRock wins either way. Here's the core debate. Is BlackRock validating Bitcoin or absorbing it into the traditional financial system? On one hand, institutional demand increases price stability. Regulation brings legitimacy. Pension funds entering means long-term capital. On the other hand, centralized custody grows. Wall Street influence increases. Narrative control shifts. Bitcoin was designed as a peer-to-peer system. But financialization changes incentives. The more Bitcoin integrates into traditional finance, the more it behaves like traditional finance. That doesn't mean Bitcoin fails. It means it evolves. For everyday investors, this shift has major implications. Volatility may gradually reduce as institutional capital grows. Bitcoin may become more correlated with traditional markets. Regulation will increase. Long-term legitimacy strengthens. But one thing remains unchanged. Self-custody still exists. Bitcoin's base layer hasn't changed. The network is still decentralized. The difference is how people access it. So the real question isn't, is BlackRock good or bad? The real question is, how do you position yourself in a world where Bitcoin is no longer an outsider, but part of the global financial machine? The entrance of BlackRock into Bitcoin marks a historic shift. This isn't retail speculation anymore. This is institutional integration. And whether you see it as validation or strategic absorption, one thing is clear. The game has changed. If you want more deep breakdowns on crypto, gold, and global finance power moves, subscribe. Because the next decade of money is going to look very different from the last.